Yeah, tax will be the big issue for either candidate, whoever wins, because obviously the Trump tax cuts expire at the end of 2025. The bad news there is that neither party wants to eliminate them altogether.
Hello and welcome to Connecting the Dots, the podcast brought to you by M&G Investments, where each month, experts from across our global network of investors will join us to bring you their views across equities, fixed income, private markets, and occasionally the macro picture. My name is Romel Patel, and I'm delighted to be joined today by Anthony Balestrieri, Chief Investment Officer in the Americas, and Tony Finding, Fund Manager based in London. Welcome to you both.
Thanks, Romel.
Yeah, hello.
Well, as you both know, elections tend to dominate the news cycle, both at home and abroad. But beyond the headlines, what really matters to investors? In other words, what evolution of the economic fundamentals are investors tracking and why?
Yeah, well, certainly from our point of view in the macro team, I would say there are three key variables that we look at here, and that would be profits, it would be inflation, and it would be real interest rates. So if the election, wherever it may be, doesn't fundamentally alter any of those three, then I think the long-run trajectory for markets ought to be somewhat unchanged. But any measures that do attack profits or kind of promote huge profits growth would have long-term consequences. Likewise, the inflation, which we've just kind of touched on, potentially some inflation risks in the system. Again, that affects the rating of assets. What kind of required yields do you need on fixed income assets and everything else? And kind of real interest rates. Again, the valuation of all assets are impacted by that. So we really try and kind of filter out the noise and focus on the sort of trajectory as a result of the election or any other event on those fundamental factors that we think anchor the returns that investors achieve off kind of assets in the very long run.
Yeah, tend to agree. Those are the things we look at. Just looking at it a bit more granularly in the U.S., obviously, we've talked about the fiscal trajectory is not great. Concerned about how that ends up affecting inflation. And then we are certainly slowing in the U.S. A lot of talk about soft landing versus recession, but you are seeing some signs certainly in the lower economic stratas of stress. So while inflation has come down, it's, prices are still 20% higher than they were pre-pandemic. So I think people a lot of times they look at the rate of change versus the level, and the rate of change certainly it looks good now, but the level is still problematic for many. So that puts some stress on the lower level. And you've seen that in, credit card delinquencies, auto loan delinquencies, and watching that to see how far up the economic strata it moves. You have seen a lot of the consumer facing companies, face some stress that goes, from the luxury providers down to the quick service restaurants, where they've had to retrench. Earnings have not been good, which once again indicates some stress on the consumer side. So those are things we're looking at. We don't expect big changes from the election, but we think there's some trends that are in place that are worth just keeping a close eye on.
Well, Anthony, what will investors be looking out for in the event of either a Kamala Harris victory or a Trump 2.0 presidency? In particular, when it comes to spending promises, you mentioned fiscal discipline, given the government is currently running a cumulative deficit of $1.9 trillion so far in the current fiscal year.
Yeah, I think that's the troubling part. Neither party has shown any discipline when it comes to fiscal spending. The 1.9 trillion number is big, but if you put it into context, we're running deficits that run anywhere between 5 and 6% of GDP. And if you look at the Congressional Budget Office estimates, it looks like we're going to be running deficits in excess of 5% for the next 10 years. Not good. We get away with it because, we are the largest economy in the world. We are the reserve currency, but we're spending like we're in a recession. And in fact, the economy is growing rather robustly. On top of that, the expense of interest, it's approaching $1 trillion just in interest expense. That's about 12% of what we spend every year. And that number just goes up. So the concerns I have around that is that do you end up getting a crowding out effect where the government is coming to market to continually fund new initiatives, pushing more debt in, and obviously your interest expense going from a world of zero rates to a world of rates that are significantly higher, puts pressure on other asset classes in terms of competing for funding, and then keeps longer rates higher than they would be otherwise.
Yeah, no, I'd totally second that. I have to say, sort of neither party appears to have any intention really of addressing this huge fiscal expenditure. And I think it almost appears to do so would just be political suicide. So it just seems to be kind of promises, and it's a question of where that goes. I don't know how you feel, Tony, about kind of other stuff around kind of tax policy or business regulations, tariffs, antitrust, those kind of factors.
Yeah, tax will be the big issue for either candidate, whoever wins, because obviously the Trump tax cuts expire at the end of 2025. The bad news there is that neither party wants to eliminate them altogether. So on the Democratic side, they want to maintain the tax cuts for people to make under $400,000. That it would add another $4 trillion to the deficit. Trump is obviously talking about extending the entire package and maybe adding more tax cuts. So those numbers that I gave you before in terms of, the projections that CBO makes assumes that all those tax cuts go away. And in fact, we know they're not. So it's going to be, a significant portion of it or all of it, depending on the candidate, they'll attempt to push through. So on the tax side, it just aggravates the situation. The flip side is if you look at, executive orders on trade, the dynamics on trade are interesting because there's a lot of concern around Trump, and you're in a campaign season, so lots of rhetoric is thrown around. It's just sort of one-upmanship, and it's whether it's no tax on tips, down payment assistance on new homes, capping grocery prices. It's all these goodies that candidates throw out to try and generate votes. The reality that a lot of that stuff goes through is pretty small, but it does indicate lack of fiscal discipline. So that will be challenging. Once again, tariffs, if you look at the tariffs during the first Trump administration and then what happened when the Biden administration took over, oddly enough, most of the tariffs were left in place. They weren't taken down. And then if you look globally now, right, we're deglobalizing. It's a tariff war. So, obviously electric vehicles, 100% tax in the US. A bill was pushing through the other day that looked at Chinese content in EVs. Europe is doing something similar. All of that I don't think is constructive for growth. I think net that ends up being a tax on the world. And it's beyond cars. It's, because of the pandemic and the supply chain issues and concerns around domestic security, we're onshoring supply chains, and there's a desire to get industries that were abroad back onshore. And in most of the Western countries, we're just not good at it, right? So if you think about EVs, China dominates there. They make 4 million cars more than they need every year. Solar panels, same thing. Wind turbines as well. But we in the West want to onshore all that stuff. So, we're laying tariffs on those goods to not allow them in our country to try and let domestic businesses evolve. There's a cost to doing that, which I think ends up remaining, it's higher rates and it is somewhat inflationary. So the picture isn't great. I don't know what you think, Tom, but
I just think how all of this ultimately manifests itself is really interesting, and that kind of inflation issue as well. Do we just continue to be in a very, very low inflationary world? And I think you're putting an awful lot of onus on sort of the technology side there, advances in AI and everything else to kind of keep a lid on inflation. But all of this borrowing, how does it eventually resolve itself? And analytically, I think that really does kind of pose some issues for where you think kind of bond yields ought to sit. What is the shape of that yield curve? Will investors demand a risk premium for long-term inflation risk? And I think we just kind of going to keep an open mind on sort of how it resolves itself ultimately.
Well, 2024 has seen the largest democratic exercise in human history, with billions of people taking to the ballot boxes to action their right to vote. We've had election results from the UK, India, Indonesia, Mexico, France, and many more. Now, all eyes are on the US, specifically Congress and the White House. The options for voters are a second term for a Trump presidency, or the first female president in US history should Kamala Harris emerge victorious. Well, let's go to Anthony in Chicago for more. Anthony, how are things looking on the ground, and what are you keeping an eye on?
Well, certainly there's been a lot of focus on the U.S. election, particularly the top of the ticket. This has been a very unusual election cycle where you had a sitting president who stepped out of the race midway and a vice president who stepped in. That being said, the election still remains very close. And while the market is focusing on the top of the ticket, I think the more interesting fact is what's going to happen behind the ticket. So that's really looking at the Senate and the House of Representatives and how that plays out, because that will really drive what whoever gets elected will be able to do once they're in office. And if we just set the stage there, if we look at the Senate, the Democrats currently enjoy just a 2-vote lead in the Senate. Joe Manchin of Virginia is retiring. That seat will likely go Republican. So that puts you at 50-50 in the Senate. And if we look at what's going on, a third of the Senate is going to be reelected this year. More Democrats are facing reelection in states that Trump won than Republicans are facing reelection in states that Biden won. So the math works in the Republicans' favor. It's likely that Senate will move to the Republican side. The House is just the opposite. If you look at the House of Representatives, Republicans enjoy a modest lead there. The entire House is up for reelection this year. But more Republicans are facing races in states that Biden won, that Democrats are facing reelections in states that Trump won. So the math, in that case, works in Democrats' favor. So it's likely that those two houses will be split, which will limit the amount of legislation that will be able to be passed by either party, regardless of who wins the election. Tony, I don't know how you guys see it from Europe when you look at the landscape here in the U.S.
Sure. I think that the good thing with the U.S. system, really, as you just described it there, is the sort of the checks and balances. And I think if that is indeed the case, kind of come November, then how much power, the president's actually going to have will be checked. So it's then all about compromise. And then I think, who wins is actually not that important for investors in American assets. I think the trajectory of the global economy is sort of seldom sustainably influenced by election outcomes. And I think if that sort of outcome is what happens in the US, then I think that's it ought to just be any short-term noise, really, in terms of market behavior.
Well, markets can overreact when unexpected outcomes are produced. That's something that we saw following the Mexico election results. Does this also create potential investment opportunities?
So it certainly does. If we get a genuine overreaction in markets, this would be something that we as investors would be looking to potentially exploit. Our framework does keep a sense on those kind of medium-term anchors in terms of inflation, profits, real interest rates. Mexico's a great case in point here. So you had an election where the ruling party wins, ends up having a bigger majority than people expected, which kind of spooks markets because things like judicial reform would be seen as kind of market unfriendly. But in the case of Mexico, you've got an economy and a government that has kind of over the last several years produced some very good kind of economic outcomes in aggregate. The Mexican peso's had been one of the strongest performing currencies. And then you get a surprise around the election, and it's the extent of the election victory that causes the Mexican stock market to fall over 10% in one day. This was something that we as a team did look to exploit, and our macro strategies did tactically engage in Mexico around that time.
Yeah, I would agree with Tony, is that the valuation framework in the U.S. is not compelling at the moment. Things are priced fair to expensive. So you certainly would welcome a shock that will allow you to step in. I think we both work with a valuation framework, and we look for, stealing one of your terms, Tony, an episode where, the market overreacts to a particular fundamental note, which allows you to step in if you take the longer view. It would be, right now the market seems to be shrugging everything off. So whether it's, slowdowns, if you look some of the geopolitical stuff that's going on globally, you've got Russia-Ukraine still going on, and Middle East is heating up. The market just is shrugging all of that off. And valuations are not very compelling. So a little bit of volatility would be very welcome.
Well, elections come and go, but disciplinary forces are ever present. How cognizant should politicians of today be about real-time feedback from markets?
I mean, it's an interesting question. So if take the U.S. as an example, if you were to have politicians key on market outcomes, the markets have actually performed very well in the U.S. But you could say a large part of that is from us throwing a lot of money, whether that's fiscal or monetary, at the economy overall. So we spent trillions of dollars, with pandemic aid. There's been the Inflation Reduction Act, the CHIPS Act, the Infrastructure Act. So all those things have kept momentum going. So the market's reacted well to that. On the flip side, if you look at the balance sheet side of the equation, it's been deteriorating, right? The deficits are going up, interest costs are going up. So the long-term trends are not great, but the market certainly is loving what's happening right now. So, the message you get necessarily as a takeaway from the market for politicians is unclear. I think politicians generally are a short-term animal where they're looking toward the next election. So, they're looking to their next vote, not necessarily looking at the long-term implications for the economy. They certainly will react as things deteriorate. My expectation is nothing changes until you get some bad news.
Yes, in fact, I remember, the Trump administration. He was often pointing out the S&P 500 as a sort of barometer of the success of his economic policies. But I think, in the case of the UK, just a couple of years ago, in 2022, Prime Minister Liz Truss, certainly her tenure as Prime Minister was very short, and I certainly think that kind of the performance of markets, the big sell-off in quite a chaotic fashion in the UK gilt market, the fall in sterling as well, were a contributing factor. And I personally, and I think most people would think that given the recent election in the UK, that the Labour Party is very, very conscious of that episode. And I do think that is potentially checking sort of their willingness to do anything too radical with fiscal policy. But we'll see.
Well, we could go on, but sadly, we must leave it there for this episode. Anthony, Tony, thanks indeed for sharing your insights with us. We really appreciate it.
Thanks, Rommel.
Yeah, thank you.
And thanks to you, our audience, as ever, for tuning in. Don't forget, you can subscribe to our podcast, and we look forward to seeing you next time. But it's goodbye for now.